Hello, welcome. Uh, this is Caleb. I'm going to share uh, my video with you. I studied uh, the book, The Warren Buffett Way, Chapter 6, The Psychology of Investing. Okay, we know investing is not easy, right? Why? I think because of not just of money or investing. It involved our emotion and psychology. Then uh, how can we overcome our emotion in investing? Let me share the story, okay, with the book. Introduction. The book in chapter 6 start with Buffett, the first common stock investment experience. We know, right? He bought 6 shares of CD service preferred stock at the price 38 and 25 cents. But after he bought, the price down 30%, $26.95. Maybe he made frustrated and discouraged, right? After a few days or a few months, the price backed up and he sold whole shares with a small profit. But he keep watching and he more frustrated because the price went up even more than $200. It was the painful experience to Buffett, but it was valuable experience. He learned be patient is very important in uh, stock market. Stock price may have little to do with company value. Then what moves price is human behavior. And human beings being collected and collective decision move the stock price. The entire market is pushed and pulled by psychological forces. It is the introduction of the chapter 6, the book, uh, The One Way. Let's move forward. This book uh, introducing the intersection of psychology and economics. Investors' worst enemy is not the stock market, right? But oneself. So, master your emotions to win the market, is said by Ben Graham. Miss Ben Graham introducing the Mr. Market. He personally personalized the market in person, right? The market some days is very cheerful and costs a very high price for shares in your business. At other times, Mr. Market is discouraged and costs a very low price. Now, how to protect yourself from the emotional, the Mr. Market, whose character is so wild, right? We must become familiar with behavioral finance, that place where finance intersect with psychology. Also, the book introducing us the three principles of stock market. Yeah, number one, first, stock. You are participating in the stock market is a business. We have to approach it as a business. Yes, businesses sometimes up, sometimes down, sometimes sunny, sometimes gloomy, right? Also, when we enter the market, first of all, we have to uh, check up the margin of safety. We don't. We have to be very very careful to enter. It should not be uh, the. We never enter in the top, but who knows it's top or not? That's why it's difficult. Okay. Um. Then yeah, we did a very huge topic, so we'll share it next time. But yeah, compared to the intrinsic value of the company, we have to buy as long as we enter the market with low price. Third, the attitude. How come? What make difference between top 1% and the other 99%? That's attitude. We need good attitude approaching the market. We need emotional ballast, heavy mind, never moving, never uh, like frustrated, never too much excited. Yes, sometimes we have to ignore market up and downs. Yes, um, behavioral finance. What is behavioral finance? Yes, the intersection of finance and psychology. Finance is cold, full of cold numbers and then soulless data. But in this finance area, psychology is uh, intersect. So we call this intersection area is behavioral finance. Because of this, stock market is so difficult to master. But without master this part, yes, we cannot win the market. Inside the behavioral finance, uh, four section is introduced. Number one, uh, overconfidence. Number two, over action bias. Number three, loss aversion. Number four, myopic loss aversion. Overconfidence is uh, overconfident of data when you collect, and then your knowledge, your information. So you may overestimate your skills and knowledge, and you are overwhelming maybe. Also, you may think you are smarter than others. Because of overconfidence, you may make big mistakes. What is overaction bias? Overconfidence is exacerbated by overreaction. People tend to overreact to bad news and react slowly to good news. So psychologists call this of reaction bias. Yes, that's why market, when it drop, yes, people sell off with foolish price. Behavioral finance explains market inefficiency by using psychological theories. Why people make foolish mistakes and illogical decisions dealing with their own financial affairs. Yes. Loss aversion and myopic loss aversion I will explain in next slide. Yeah, I share this slide with my Korean friend, so there's some Korean letter. What's loss aversion? Uh, People don't like loss, right? Even hate, and then frustrated when they face the red color of the number. The solution is this: when you get 100 gain, uh, you feel, yeah, it's good. You may you measure this much of pleasure or uh, excitement, but when the price down $100, the amount is same, gain and loss, but the feeling, the emotion is 2 times or 2.5 times is bigger impact you can feel and discard it. And emotionally, you deeply impact. So we call it this difference is loss aversion. This theory is 1979. Dr. Kahneman and Tversky, the psychologist, they issued the paper. This theory analyzes the decision on the risk. This this psychological phenomenon impacts our decision when we make the buy or sell the stocks. Yes, because of this much of the your satisfaction when you get gain. Yes, the greed is involved, so you don't take the profit, right? Then because of this big impact, you hold on to bad choices for too long. You don't sell with loss. Because of also this impact, the people's the portfolio is too much conservative and too much money on bond. For the 401k, yeah, is people hold this account 10 years, 20 years, 30 years, right? Also, because of this, psychological inside of the of people, they have a short-term horizon, like shortly and uh, trade many times a day, or right. Myopic loss aversion, right? Myopic is very short eye, right? Longer investor hold on asset. The more attractive the asset becomes, but only if the investor is not evaluated frequently. Loss aversion, right? Already I explained. People hate loss, right? That's why people, uh, yeah, because of people don't like loss, they quickly check the their account, evaluate period, frequency of evaluation of period. These two things bring emotional turmoil in people. When we check daily, loss change 50 to 50, right? Chance. Uh, the Thaler and Bernarchi research determine the ideal time frame. No, the answer is 1 year. Simple function U is like probability of price up and minus price down and probability of price down times 2. And 1 day, 1 hour, 1 day, 1 week, 1 month, 1 year, 10 year, 100 year, they calculated, right, with this function, and the price so become this function, the result become positive when check up by 1 year. Buffett preference once a year for trading dovetailed with the psychology of finding a myopic loss aversion. The this is theory, right? Myopic loss aversion and Claro and uh, Bernarchi research is a theological approach, but Buffett's preference is come from the came from his experience. It's dovetailed, it's matched, right? And theory and human experience same and showing same result. Managing the emotional traps. Myopic loss aversion is the most serious thing. Buffett mastered this, and he could be the world's greatest investor. Berkshire invested $1 million in Coca-Cola in 1988. Over the next 10 years, it went up tenfold. For 10 years, only 6 years outperformed the stock market. Coca-Cola had a negative emotional utility. What I showed before the 6 minus 4 times 2. 2 is from the loss aversion, came from loss aversion. Loss aversion trap. People sold Coca-Cola before the price went up. Buffett checked the economic data of Coca-Cola and kept the share. How many times you should check your account? Buffett way on risk and diversification. Buffett's principle was emotionally and psychologically disconnected from the behavior of the majority of investors. What is risk? Yes, the volatility of the share price. But Buffett has different view. He uh, he saw the price down as a buying opportunity. Buy the deal, right? Different definition of risk. Intrinsic value risk of business, not the price. Risk Buffett is linked to an investor's time horizon. If you extended your time horizon out several years, the popularity of its risky probability of its risky transaction declines meaningfully. But by start today, sell it tomorrow, the odds are just 50-50. If you extend your time horizon out several years, the risk is almost zero. If you are unconcerned with short-term price volatility, then you will also see the portfolio totally different diversification in a different light. What is Buffett's way and risk and diversification? While we diversify, yes, diversification serves as a protection against ignorance. Let's see this chart, this image. The knowledge left end is zero. You don't know anything. And then right side, you have full knowledge of the company. Then what do you do? You know, this company price goes up 100%, or you down 100%. What do you do? Yes, you do something, right? This one, let's think you buy S&P 500 all stocks. You buy 500 stocks. What will happen? Yes, you diversify a lot. And then in this middle. What is Buffett's way? Yes, Buffett chose the right side one. His investing is focused investing. Focused investing. This this chapter introducing the Harry Markowitz and Ungen Farmer and Bill Sharp. Their theory is covariance and the effective market and capital asset price model. I don't share these theories, but they they brought out many like modern portfolio theory, MPT, but Buffett don't follow these academical theories. Maybe Wall Street would follow the ways. Okay, this one I brought from the chapter 5. Chapter 6 don't introduce the Buffett's the portfolio, but just mention he is different from the academic theories. Buffett's way is focused portfolios. Here, one 12,000 portfolios are introduced, and 1,200 companies companies in balance, comparing four portfolio groups. Each group have 3,000 portfolios. First group, each portfolio has 250 stocks. Among 1,200 companies, they chose 250 stocks. And 250 times 3,000, right? This portfolio is one group. And 3,000 with 100 stocks. Each pro portfolio has 100 stocks, and 50 and 15. Yes, it is on to the top. Yeah, much diversified, and downside is focused, right? The wider reason. Standard deviation. This chart is standard deviation. Standard deviation is like increased, right? It means it's volatile. It means less diversified is more volatile, right? More diversified, yeah, less volatile. That's why standard deviation is less, small number, right? Yes. How about profit? Wow. Focused portfolios has more profit and less loss. So the chart is showing that gain is more higher with focused, and loss even lower with focused. I mean more diversified, right? More diversified. Oh, very average number is showing, right? This portfolio chart showing that Buffett's way is more overperforming the S&P 500 and the market average. So Buffett's way is very rational. Buffett is very rational, not emotional. Left side is academic, and then short-term approach, and then modern portfolio theories, but it is fully successful. The investors, they fully experienced, and then they mainly focused the portfolio and later price. They focus on the companies, not stock price. They focus intrinsic value. Let's have a conclusion. Why philosophy matters. In 2002, Daniel Kahneman, the psychologist, awarded the Nobel Prize, right? It means the psychology, the behavioral finance, the formally arrived in the stock market. It's the people who makes market despite a computerized world. Emotions are stronger than reason. Fear, greed moves stock prices above and below the company's intrinsic value. When people are greedy and scared, they often will sell stocks at foolish prices. When it comes to investing, emotions are very real. They affect people's behavior and ultimately affect market prices. Two reasons to understand the human dynamic. First, avoid the most common mistakes. Second, make a profit from other people's mistakes. The only antidote to emotional driven misjudgment is rationality.